everyone, and thank you for watching my videos. In the previous video, I showed you the first technical indicator that is available on our trading platforms that we can use to increase our chances of making successful investments. I showed you moving averages. So, this video, I'm going to show you many technical indicators that we can use on our trading platforms that can give us a strong advantage in this market. The first of such technical indicators that I'm going to show you are the Bollinger Bands. Now, Bollinger Bands, they measure the volatility in a market. It tells us whether or not the market has little action or the market has a large amount of action. So, this is important because Bollinger Bands can give us an indication of where to enter the market. So, here's what a chart looks like with Bollinger Bands. Notice that in the beginning, the Bollinger Bands are close together. This tells us that there's not too much action in this market. But notice that when the bulls are taking over, the bands spread further apart. This is an indication that this market is a bullish market and there's a lot of volatility. So many investors, when they see these bands stretching further away from each other, investors will more than likely enter a long position in this market. Next, we have the Bollinger Bounce. Now, the Bollinger Bounce is a strategy that we can use with the Bollinger Bands indicator. It works like this. Notice that once, twice, and 3 times a bullish candle pierced through the top of the band, and then the market retract from that piercing. So, when the market is going sideways, now I don't recommend this in an uptrend or a downtrend. When the market is moving sideways, it's more likely that candles are going to bounce from the bands after they've hit them. So many investors that are looking for a quick profit, they'll wait for a bullish candle to breach the top or wait for a bearish candle, as we see twice, to touch the bottom of the band and then enter the positions based on how much they can bounce from each band. So again, I'm not going to tell you in this video where to go short and where to go long, but I can give you an idea as to what the majority of investors around the world that are looking at the same charts we're looking at and try to make an estimate as to what the majority of investors are most likely to do. So again, I stretched this chart out a little bit more. In a sideways market, keep in mind, candles are more likely to stay in the middle between the bands. So then we have the Bollinger Squeeze. The Bollinger Squeeze works like this. The bands squeeze closely together. However, a bullish candle pierces through the top, and look what happens. A new bullish market has begun, and the Bollinger Bands give us an indication that the bullish market is for real. So many investors will jump on the long position when they see many bullish candles piercing through the top. Now, about Bollinger Bands, there are mathematical formulae in order to determine how to calculate Bollinger Bands. Again, we don't need to memorize any mathematical formulae because our trading platforms will take care of all of that for us. So the only reason why I put the mathematical formulas in my charts is because I think it's very important for us to know the true origin of these tools so we can better appreciate what they can do for us. Otherwise, we have a bunch of tools, but we don't know how to use them. So that's the only reason why I put the mathematical formula in here. So let's move on to the next indicator. Moving average convergence divergence. So we're going to, for a moment, go back to moving averages because moving averages, they help us immensely when we are opening positions in this market. So the MACD works like this. It's an acronym for moving average convergence divergence. What it does is it measures how far apart or how far together the moving averages move against each other. So we use MACD to determine a good place to enter a long or short position. They can even tell us what a trend is about to begin or when a trend has begun. It can even tell us a trend that's about to begin before it begins. So, when we activate the MACD on our trading platform, the chart will split into two parts. We have our candlestick chart on the top, and we have this chart on the bottom. So we have our two moving averages, and again, the faster moving average is above the slower moving average in a buyer's market. The slower moving average is above the faster moving average in a seller's market, as indicated in this chart below. These green bars, if you can see, this tells us the differences between the two moving averages, and they can also help us indicate whether or not a trend is beginning or ending. Notice that there seems to be a line between the bars going up and the bars going down. So when we see bars going down, that is an indication that we're in a bearish market. Bars going up tells us that we are in a bullish market. So on an MACD chart, we usually see three numbers, and when we activate the MACD chart, we have to enter three numbers. Now again, just like in the previous video, we can enter whatever numbers we want. We're not restricted to certain numbers. As you gain more experience as an investor, and as we learn how to use moving averages, it's up to you to choose which numbers work well for you. However, when we enter these three numbers, keep in mind, the first number we enter will be our faster moving average. The second number that we enter will be our slower moving average. The third number that we enter, that will be the difference between the two, as indicated with those bars that we saw. If we do not enter a number into the trading platform, they will set default numbers for us. And the default numbers are more than likely 12, 26, and 19. So the number 12 is for the 12 period moving average. The 26 is for the slow moving 26 moving average, and the 9, that will be the number of trading periods indicated on the histogram. So again, here's what everything looks like, and notice that the purple line is the faster moving average, the black line is the slower moving average, and then these two lines on the bottom, the blue line is the 12 period EMA minus the 26 period moving average. So the blue lines, keep this in mind, on the bottom, the blue lines and the red lines, they are not the moving averages themselves. So do not confuse these lines on the top with the lines on the bottom. They are not the same. The moving averages are only on the charts above. These two lines below, this blue line is actually measuring the difference between the two moving averages on top. And the red line, that's just the signal line. It just indicates the 9 period moving average of the MACD. So again, this blue line right here, this is the line that measures the difference, and this red line just compares the differences with the signals indicated on the lines above. These bars right here, again, that's the histogram. That represents the third number that we input, and this actually represents the differences between the two moving averages in bar form. And again, we're looking for crossovers because when here we have one major crossover, and notice how this crossover corresponds with this crossover here, which begins the bull market. So, the mathematical formulae for MACDs are as follows. What does this mean in real English? It just means that the blue line that we just saw, that's just the difference between the two moving averages. And the signal line, that's the red line, that will be the 9-day average, that third number that we just indicated. And the bar graph, that's just the differences between the two lines. So again, the two lines on the bottom of that chart, those are not the moving averages. The moving averages are on the top chart. So, here are the meanings of those lines. We're looking for crossovers. When the lines cross over, that indicates that a new trend is ending, or an old trend is ending and the new trend is beginning. And again, this corresponds, the crossing over of the moving averages generally correspond with the crossing overs of that red line and blue line on the bottom, and the crossing overs of the bars pointing downward and then the bars pointing upward. So how do we trade with MACD? Well, we look for divergence. Divergence is when the lines are moving away from each other. So as we see lines moving away from each other, the two lines on the bottom, this gives us a clear indication that the new trend is for real. So as we see, on the beginning, the slow moving average has moved away from the fast moving average. This confirms that we are in a bearish market. And then notice that after the crossover here, the faster moving average moves away from the slower moving average, moving up like this. This confirms that we are officially in the bullish market. So, also when we trade with MACD, and this is why many investors love this tool, because we can see trends before they happen. Here we have an MACD crossover right before this big bullish candle. So crossovers are very important because it tells us when trends are beginning, and that's how investors maximize their profits, by getting involved in the market before the trend begins. So we use technical indicators to give us stronger technical analysis, to give us more advantages in this market, because we need all the advantages we can get in order to be successful traders, right? Okay, let's talk about another technical indicator, the parabolic SAR. SAR stands for stop and reverse. Again, this is just an indicator that tells us when a trend is beginning. Now, here's what it looks like on the chart. You see these dots? These dots indicate that the trend has begun. When we see we're looking for at least 3 or 4 dots to confirm whether or not we are in a bear or bull market. So when we see dots above the candles, it means we're in a seller's market. When we see dots below the candlesticks, it indicates that we are in a buyer's market and we should go long. So investors use this tool to indicate where to go long. Investors will go long when they see 3 or 4 new dots forming at the bottom. Investors will short this pair when they see 3 or 4 dots forming and on the top of the candlesticks. So how do we use parabolic SAR to our advantage? When we see dots on the top, we sell. When we see dots on the bottom, we buy. It's that simple. So again, we can also look for breaches. So in a bull market, when we see candles crossing over the dots, that can also give us a good signal that we should go short if a bearish candle breaks one of those dots, or if a bullish candle breaks one of the dots in a downtrend. So about the stochastic charts. The stochastic charts, they tell us, it's actually more of a warning, letting us know that there are either too many buyers in the market or there are too many sellers in the market. So notice that on the bottom of the stochastic chart, we have two parallel lines that are dotted. This red line, anything above the red line indicates that there are too many buyers. And anything below this blue line indicates that there are too many sellers. And again, we have these two lines from the MACD chart. And notice, in the part that warns us that the market is overbought, notice that we have a crossover. This crossover corresponds to the end of the bull market. And notice that these two lines, they stay in the overbought market, but they don't go down into this area. And that's because the market has gone sideways after the end of the bull run. And notice that as the two lines cross over and head down towards the oversold market, this begins the bear market. And in the midst of the bear run, we have the two lines in the oversold zone. And then we have another crossover. And as the two lines cross over, notice that the bear market has ended and the market has gone sideways a little. And then the bulls have picked up. And the fact that the two lines have crossed out of the oversold zone confirms that the bulls are in charge of this market. So the stochastic chart can tell us whether or not there are too many buyers, and if there are too many buyers, the investors will short. And if there are too many sellers, the investors will go long. Okay, and here I've placed more mathematical formulae so we understand how the stochastic chart works. So again, the stochastic chart, this is popular with investors because this tells us when will the trend end. So far, we talked about indicators that indicate when the market will begin a trend. We also learned about indicators that tell us when the market will begin its trend before it actually begins. And now we have indicators that tell us when will the trend end. And again, another example of the stochastic chart is that we have another crossover in the overbought, and then the market goes down. And when these two lines cross over in the oversold, the market also reverses its trend. So again, overbought, investors will sell. We have two overbought signals in each chart. Oversold, investors will go long. So again, two buying signals. So it's all about looking for signals. The signals will tell us when we should open our positions. The signals will tell us when we should close our positions. And the signals will tell us when the bull market will begin. The signals will tell us when the bull markets will end. The signals will tell us when the bear markets are about to take over, and the signals will tell us when the bear markets are finished dropping the prices. So these indicators can give us a really good advantage in this market. Now let's talk about relative strength index. It works like this. It simply tells us whether or not the market is overbought or it's oversold. So when we see the two lines in the overbought zone, many investors will go short. And if the lines are in the oversold zone, many investors will go long. As we can see, over 70% overbought and time to sell, under 30 overbought and time to buy. So here's how it works on a larger chart. And again, here the market is oversold, so many investors have chosen to go long, and they are enjoying a really nice sizable profit. So again, here the price is continuing down after the RSI has crossed over 50 and is confirming that this is indeed a bear market. So here are the mathematical formulae for the relative strength index. Again, we don't have to memorize these, but your trading platform will calculate these for you if you wanted to have a fuller understanding as to how relative strength index works. That's why I placed these in here. Now, let's talk about average directional index. What the average directional index does is it measures how strong a trend is. So this doesn't tell us whether or not we're in a bear market or a bull market. It tells us how strong the uptrend or the downtrend is. So as we can see, the directional index is less than 20. It means the market is really weak and slow. However, the downtrend is pretty strong, and it's indicated by the average directional index, which is greater than 50. So again, the average directional index is not going to tell us if it's a bear market or a bull market. It's just going to tell us if the bear market is strong, we should go long. I mean, if the bull market is strong, we should go long. Or if the bear market is strong, we should short. And if the uptrend or downtrend is not that strong, probably the trend will reverse itself soon. So again, the ADX is above 50 in an uptrend. It means the buyers are indeed in control of this market. And how do we use ADX? Well, it's simple. We wait for the breakouts before we decide to go long or go short. So again, what we're looking for is the strength of the bull run or the bear run. And it's better to not use the ADX on its own. We should use the ADX with some of the other tools in our trading platforms. Okay, now to the last one. And this is actually a very difficult one to use. It's called Ichimoku Kinkyo Ho. This is used to indicate future price momentum, and it's also a good area, shows us a good area of support and resistance. Now, this is actually not a very common tool to use because of its complexity, but it is very popular among Japanese yen crosses. And just to give you an idea as to how this works, well, in Japanese, Ichimoku means glance, Kinko means equilibrium or equal, and Hyo means chart. And as you can see, it's a very complex chart. However, some investors find it very useful because it tells us where we can find support and resistance. Also, it has some examples of moving averages and can even give us an indication as to which direction trends might move. So this line, the Tenkan-sen, is an example of a moving average, and the Kijun-sen averages out the closing volumes. And then the Senku, which gives us an indication as to which direction trends are heading in, and then there's the Senku span B, which kind of gives us a good zone. instead of a line. Because remember, we can't always depend on lines. Sometimes we need to think of lines as zones. And then also the Chiku's band, which kind of gives us a support area. And the Kumo, which means cloud in Japanese, is the space between some of the lines. Actually, in this case, between the two Senku lines. So, how do we use all of this? Well, what we're looking for is balance and equality, in which I explained the word Kinko means equality and balance. So what we're looking for is we're looking for the support, the resistance, the crossovers, and the indicators. Because with all this information combined, we have a general idea as to where the prices will move in the future. So supports, we have that with the green line. Resistance, we have that with the two Senko lines. Crossovers, we have that with the two moving averages. And the trend indicators, in which we have with the Tenkan-sen. So, how do we combine the tools? Combining the tools gives us a maximum advantage when we're using technical indicators. So here, this is an example of using Bollinger Bands and stochastics. As we can see, we're looking for the space between the Bollinger Bands, and we're combining that with areas that are overbought and oversold. So Bollinger Bands and stochastics, that gives us a really good advantage in this market. Here's an example of relative strength index and MACD. Looking for areas that are overbought, and we're looking for crossovers to begin or end new trends. So combining these areas tells us where we can buy or where we can sell. Again, a great opportunity to maximize our profits in almost every investment. Now, we've learned the many different tools on our trading platforms, and we learned how to combine tools. However, there is no such thing as the perfect tool, and tools have to be used properly or they won't work at all. Remember, this is the Forex market, nothing is certain. And thank you for watching my video, and good trading.